What's going on, my people, my people, my people? What's poppin'? It's your girl MuMu. We live right here. Live and direct. So I come today to drop some gems for all of you. Why? Because I care about you guys. And so this is going to be the first series of many. This is part one. So get your pens, get your pads, and if you can't make it, you can always watch the replay. No problem. You know, I'm doing it for the community, doing it for my people. And what I'm going to be going over is the fundamentals of the stock market. That's right. The fundamentals of the stock market. Now, it's buku fundamentals, right? Buku. Buku fundamentals. So let's start with portfolios. What is a portfolio? And you know, some of the stuff I'm going to be referencing from Google, so you don't have to take my word for it per se. But oh, also if anybody have any comments or questions, I'm on Zoom, so I'm also live on Facebook, Instagram, and YouTube. Because I'm on the Zoom, I'm not able to see uh the live comments or the live questions and things like that. But if you DM me, I can definitely respond. But hold your questions for the DMs because on the Zoom, obviously I can't see them because I'm on Zoom and not literally on the social media platform. So just putting that out there because if you ask me a question and I don't answer it, that's why. So, without further ado, go ahead, get your coffee or your midday snacks or what have you. And we're just going to go over some basic fundamentals and some things that you can write down if anybody's interested in the stock market. This is all fundamentals. This is nothing technical. We have to understand the difference between fundamentals and technical. So let's start with that. Fundamentals, that's like research, information, experience, knowledge, wisdom, stuff like that, right? Technicals, that's more so of strategies, moving averages, price action, market structure, things of that nature, more technical things. So it's more so like, to sum it up, information versus technicals. Best way I can put it. So we're gonna go over, so let's do portfolios, right? We'll start with that and dig a little bit into how does the actual stock market work. So it's always just cool because some people is like, I have money, but I don't know where to start. You know, I hear that all the time, and I'm just like, okay, well, that's good because you want to invest more than you save. That's always the goal number one. Okay, but let's start with stock picking. So you want to pick stocks that are simple. First, you should invest into stocks that you already purchased from. So if you have an Apple phone, you should invest in Apple. If you shop at Home Depot, you should invest in Home Depot. If you shop at Walmart, you see what I'm saying? If you're already a consumer and you're giving these people money already, why not become an owner? An owner means that you own shares, not literally like you own the place. Because people get that misconstrued, like, yeah, I own the stock, and like, dude, oh, I own a company. That's what people say. I own a company. Yes, if you're a shareholder, you have ownership, which means you can be on those quarterly earnings calls. They're going to send you an email. You can sit in, you can ask the people questions and things of that nature. Yes, you can become an owner of a company through shares. Let's get that part right. All right, so simplicity, right? You want to pick a company that's simple, where you can Google them if you're not familiar with them, especially with the financials. You always want to look at folks' income statements, balance sheets, and cash flow. Cash flow is the absolute, for me, the most important because if the company don't have any money in the cash flow, that means they don't have good management. Okay. Does the company have free cash flow? And what I mean by that, so I'm gonna actually pull this up, right? I'm gonna share my screen because sharing is caring. Like they told us back in like fifth grade, right? Sharing is caring. Okay, right. So hold on. I'm gonna actually go to what is it called? Google Finance. So hold on. I'm getting this up. One sec. Google Finance. That's what we want to see. So we're going to go to Google, right? So we're going to type in Google Finance. Boom, look, pop right up. Bam. All right. So let's pick a random company. I'm actually in a Adobe play. So Adobe is currently trading at $258.65, right? Okay, wait, let me share my whole screen. I know. Give me a sec, enter full screen, right? Boom. All right. So let's look at all right, when you pick a stock, well, actually you could type it in up here, but since I saw Adobe, I just clicked on it, right? So when you come down and then boom, you want to make sure whatever company that you're looking at with the financials, you start with the income statement, right? Quarterly, you want to see more green than red. Point blank period. More green than red. Why? Green is a good thing. Red, no. Just like the stoplight. Green means go, red means stop. Same deal. Okay? Now, boom, revenue, operating expense, net income, net profit. Now, not too bad. Everybody, listen, there's no perfect companies out here, right? So, boom. So then you got earnings per share. Then you have EBITDA, right? 8.5%. If you don't know what it means, Google it. Then we got the balance sheet, right? Boom. Now, obviously, it's only three little items on here, which is cash and short-term investments. And that's investments that are relatively liquid and have maturities between 3 months and 1 year. So, yeah. And you can also click on them and it tells you total amount of assets owned by a company. Cool. There's our negative. Now, here's the thing about Adobe, which is not good, which is like, no, actually, it is good. So, what I was going to say, you want to make sure I was looking at the number to the right and not the actual number. So 2.950 billion. You want to make sure that the company's assets are more than the liability, meaning that this number here, 29.50, should be higher than this number. That's just like a little secret gem, right? I was looking at this one. Like overall, this is just like quarterly, right? So let's look at what it is annually. Oh, didn't change much, huh? But the date. Okay, well, they got some they work to do, but they are down right now because I'm actually in the Adobe Puts and that thing is printing. So then you have these, that's null and void. So if it's no number next to it, don't worry about it. Now, here's the kicker. Now, this is what you should do before you invest into any company. Come here and look at their financials, income statement, balance sheet, cash flow. Right. And the secret is, write it down, is you want to see more green than red overall, quarterly and annually. So now we got the cash flow, right? Boom. Now, okay. Okay. I was so free cash flow, this right here, where it says 11.72%. Now, that is what you want to see. Is green. Over 10 is cool. Over 20 is even better. But hey, they at 11, that means they got good management. Now, cash from investing, they need to work on that. That's high, right? That's probably why they sinking right now, But net income, like they not broke. Adobe is not broke, right? Y'all pull y'all little PDFs up on Adobe. I know they ain't broke. So cash from operations, 8.18%. And then you got cash from financing, that's down, negative 2.16%. And then you have net change in cash, all right? And that is year after year on the quarterly. So let's look at the annual. Okay, because if I click on the annual and the quarterly, and this number right here is red, I'm not investing into that company. Now, obviously, these are some high numbers from investing, financing, net change, and cash. Yeah, those are hot, but that's on a annual basis. That's why you want to look at quarterly and annually, because now We are still in the first quarter because we're only in February. So the quarters are between January, then it starts again in April, then it starts again in July, then it starts again in October. 4 quarters in a year, right? 4 quarters make $1. So that's what you want to look at. So that was just giving you an example of what to look for, how to start investing, right? Because everybody like don't know where I start. Like you should at least maybe have overall, I would say start with like 3 to 5 companies into your portfolio and then like grow from there. But like, where do I start? If you just like don't know anything, start with companies that you already invest in, meaning that you already shop there. You are already a consumer. If you pay your phone bill every month and you have Apple, you are an Apple consumer. If you shop at Walmart, you are a Walmart consumer. So if you're already spending money there, you shop at Target, you are a Target consumer. Why not become an owner through the shares of the company where you already spend money? You see what I'm saying? So this is just something else. So let's say like, all right, cool. I got an Apple, I got an Android, you know, just starting tactics. That's where you should start, right? Then you come in like, you know what? Let's look at it. Let's look at it, right? So let's come up here. Let's look at Apple. 262.63. This is the current price of where Apple is right now. Or 262.62. Okay, cool. All you do, Google Finance, come to Google Finance, type the ticker in at the top, and all you do, simple, right? Scroll down. So let's look at Apple finances. Look at that. Look at that, right? Look at that. Look at that. Now, all green. Thumbs up. You know what I'm saying? That's where it's at. Like green is what you want to see. Green is what you want to see. Why? Because it's like a Christmas tree. It's green. It's lovely. It's money. It means go. Yeah. All right. So that's on the quarterly. And then the annual. Hello. Not too many companies are green on annual and quarterly. Okay, cool. That's the income statement. Yay. Then you just scroll down or just move down a little bit and then you look at the balance sheet. Cool. Whoop. Hold on now, Apple. You had me for a second. And again, you want to make sure that the total assets are more than the total liabilities, meaning that it's a higher number. So 359 is higher than 285. Of course, it's in the billions because Apple is just, they're up there. Okay, so that's the annual. Apple is red on the annual with their liabilities, cash on short-term investments, which again just means that they're relatively liquid and have maturities between 3 months and 1 year. Yay. Okay, cool. Then you got quarterly. Okay, quarterly from December, because the quarter ain't over yet in 2026. So this is referring to from October to December of 2025. Boom. Green. Yes. All right, cool. So far, so good, right? Cash flow. Now, if their free cash flow is not cashing or flowing, then no man. So, boom. Let's look. All right, all right, all right. Got a little something going on. Okay, boom. Now look at this. In comparison to Adobe, Adobe was at 11%. Apple has 169.75. I mean, sorry, 57%. That's high, and that's good because anything pretty much over 20 or 25 is definitely a thumbs up because companies be struggling. Now they do got a little work to do on the cash on investing. And if you click here, say net cash used or generated in investing activities such as purchasing assets, right? So they got to work on a purchasing, okay? Then you come here, like, all right, bet net cash used or generated in financing activities such as dividend payments and loans. Now, if you are a shareholder of Apple, Apple is a dividend company. A lot of companies pay dividends, some don't. And that's just pretty much like extra money that you can get. Now, what you want to find out is if they do, well, not if, since they do pay dividends, how often do they pay dividends? Because like say like if they some do quarterly, some do monthly, some do annually. So let's say if it does annually. So let's say you make maybe, I don't know, $100 on dividends, and then you can reinvest that back into your shares. Okay, so this is just strictly like buy and hold stuff. Now, if you want to like trade daily, like what I do, then that's different. But this is more so like buying and holding and just like little beginners type stuff. Just things that you should know if you want to become an active investor. And if you already know these things, cool beans. We on the same page. That's what's up. So cool. So moving on, right? Moving on. So that is Apple. Apple looks great. So that's on the quarterly. Boom. Let's look at the annual. Okay. Boom. What's the problem here, folks? Somebody pointed out. Do you see it? Do you see it? It's sticking out like a sore thumb. Now, that net change in cash looks amazing. Okay. That is the amount by which a company's cash balance increases or decreases in a accounting period. Now, on the annual tip, that is not the business, okay? That don't mean that Apple ain't a good company. That means that they have work to do within their management, the CEOs, the CFO, and things like that. Because Apple is look at all these B's. B, 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 B. That means billion, okay? They ain't broke. They just got a little work to do. You know what I'm saying? So this is what I'm saying. So just overall, if you have companies that you already are a consumer at, definitely, definitely start your portfolio there. So you're looking for coming back to our stock picking list. So what's on our list? So we got simplicity, right? Does the company have free cash flow? That's number two. Number one is simplicity. Number two is, does the company have free cash flow? And that also means, like we just read, paying for dividends and buybacks. Okay. And is the net profit growing? You want to know that. So another site puts you on game, the net profit, where you can see like if it's growing. So another site, y'all, and you type in bar chart. Boo, 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 bar chart. Bar chart. A bar chart. So type in barchart.com, right? Giving y'all the juice in the gems. Giving y'all the juice in the gems. All right. Boom. Okay. So you come here, right? Since we was on Apple, let's go look at Apple. Since some of y'all some Apple users, y'all keep trying to play me because I got an Android. Like, don't do that. You know what I'm saying? I got an Apple laptop, and that's about as far as I'm going because I love my freaking Android. Turn up. Turn up. All right. So I'm an Apple hater on the phone tip, but I'm on an Apple laptop right now because it's bomb. I love the Apple laptop. And then, oh, you can just connect it with the watch, the iCloud, the Apple Music. Yeah. I don't need all that. Phones is too high for me. So Apple says week buy. What does week buy mean? A week buy. That's pretty that's pretty much what it means. All right. So the question was, is the net profit growing? So where do we find the net profit? Now, always, if you don't know something, you can ask ChatGPT or Google, right? But just some read on here and we're building us, you know what I'm saying? Let's see. So financials, boom. Okay. Boogity boom, boom. Oh man. Okay. So you can take a look at the finances, right? Finances. So same thing we was just looking at on Google Finance, quarterly, annually, right? You're gonna see the same numbers, but just written a little different, Written a little different, All right. So net profit. So here we are. Net income growth. So let's look at it, right? So we're gonna start from the left and then go left. I'm sorry, start from the right and then work our way left. All right, so September 21st. I'm sorry, Lord. September 2021. All right. They were up 64.92%. Okay. September 22nd. They went down drastically. September 23rd. Now, keep in mind, this is around COVID, okay? This is around COVID. Oh, Nobody was buying iPhones during COVID. They just wasn't. You know what I'm saying? People probably barely was paying their bills, they rent and all that. So 281% negative. Boom. Okay. Because look how in 2021 they was popping. COVID happened. Look how much they dropped. Boom, boom, boom. They just got worse. Like got worse, got worse, got worse. And then boom. September 25, they coming back. Like, yo, you know what I'm saying? We back. 19%. No, that's a big come up, you know. That is definitely a big come up because you can even look at the numbers right here. Boo-doo-doo-doo-doo. Right. Sales growth. Even look at the sales growth. 33%. Then it dropped. Then it dropped. Then it went up a little bit, right? So you want to make sure. I'm just showing you what you should look for, what your eyes should want to look for when you come, right? Come to bar chart and you click on the financial summary. That's what you want to look at. Is the company growing with the net income growth right here? Then, I mean, you can take it a step further. Just look down, right? Boom, total assets, total growth assets, total liabilities, total growth liabilities. Like, boom, you want to see these numbers growing. Why? Because if they ain't growing, they ain't got no money. No, I'm just playing. They do got money, but it just got a couple of things that they need to work on because you do want to see like all green there. Now, Apple is a $1 billion company, right? We know that for a fact. But what if it's a company that you know you aren't familiar with and you see these numbers and it's not Apple, right? And you're like, I don't know. Like, you know, I will write this down. I will write this down or print it out, you know, however you want to do it and get me a highlighter. Boom. And just look, right? And just like really look from 2021, you know, because this was like all COVID, right? Boom. Dang, 113. Ooh, yeah. But look, then that's drastic. Change in cash net flow. Look at that. That's bananas. Yeah, that would impress me. Like, dang, 854%. You know how much money that is? Like, they went from a negative 113 to a positive 854. Now that isn't now that is fabulous. You know what I'm saying? Not a lot of companies can probably even have the mental capacity or the finances to even do that. Like, that's dope. Like, yeah, but you want to look at all three of these things, you know, get to know what's on the balance sheet, what's on the income statement, what's the cash flow looking like. You know, you got to get into these things because you want to research these companies because if you see more red than green, bad management. That's just bottom line. If they got bad management and they're not making money, so how in the world can they make you money? That's what you got to ask yourself. So, number one, simplicity. Number two, does the company has cash flow, which pays for dividends and the buybacks, right? And number three, is the net cash flow growing? Okay. You gotta look on the balance sheet and stuff for that. And you look at the cash flow statement, like I just said, right? Number four, does the company have a moat? What is a moat? Anybody know what a moat is? MOAT. That's number four. MOAC. Okay, don't mind if I do. Let's go to Google and see what the heck is that moat. What's that moat? Moat? I don't know. It's around with coat. Shoot, I don't know. I'm bugging. I'm supposed to go to Google. All right, Google. Boop. There you go. Moat. Bam. So, moat. Nothing comes up. A deep, wide ditch surrounding a castle. That is not what we meant. Surround a place with a moat. So you gotta be more specific. Can't just I did it on purpose, right? Moat meaning in business. Look, moat slang, moat in finance. Boom. All right. So it's the economic moat is the politically correct term, right? So let's read. Together, read. An economic moat is a durable, sustainable competitive advantage that protects a company's long-term profits and market share from competitors, a concept popularized by investor Warren Buffett. Now, if you don't know who Warren Buffett is, just close the laptop. Similar to a castle's defense, which that's what the other word just said, these advantages, such as strong brands, network effects, or cost advantages, allow companies to maintain high returns and fend off rivals. Fend off rivals. That means get rid of your competition. See you later. Bye-bye. Android, Apple. They are in competition. Are they really? Whatever. So, what is it that Apple have over Android? Or what is it that Android has over Apple? Like, what are they knocking each other out with? You know? Like, people may say, okay, we got the Apple Watch, and we got the Apple Music, and we got the Apple laptop, like I was just saying, and we don't care. But then you have the Android, whose camera is just bomb. We don't need all that iCloud and all that. We need just a little phone that we can text, call. That's it. We don't need all the fancy stuff and clocking our steps while we walking and working, getting your sleep patterns together. I guess, honey, but I don't need all that. You know what I'm saying? My bill is $50 a month. Anything more than that, I'm good. So this is why I like Android. You dig? But anyway, back to the issue at hand, right? So the definition, a sustainable long-term competitive advantage that defends market share and profitability. So let's look it up, right? So boom, let's look up Apple's moat, economic moat. Be more politically correct. Then I'm gonna do Android, right? Then I'm gonna do Android, okay? A wide economic moat driven by an ecosystem of integrated hardware, software, and services that fosters intense customer loyalty. That's why y'all so loyal, because Apple produces customer loyalty and high switching costs. Okay, now they didn't even tell you right there in your face. Hello? Did y'all miss that part? Hello? High switching costs, meaning that they cost every time an iPhone come out. Folks be running to the store. I need y'all to run to Jesus like that. You know what I'm saying? Them folks, them lines be out the wazoo. You know what I'm saying? Like, ooh, new iPhone. Wait, like you just had one for like 2 years, right? You don't pay like over $1,000 for that phone. Then you better pay another $1,000 for the same phone with a better camera. Like they just gonna keep coming out like, oh, here comes the suckers. Yeah, no, I'm just kidding. All right, so key pillars include a powerful brand, the walled garden, quote, right? The walled garden. Do tell, okay? Effect of iOS, okay, and a vast lawyer user base. Y'all are some loyal folks. I can't even hate on that part. And I got the laptop, so allowing for significant pricing power and sustained profitability. That is Apple's moat. Now, I'm gonna look up on a separate one, Androids. Android. Did I spell that right? I did not. Android. Moat. I'm sorry. Moat. Boom. X. Why they trying to play us with the X? Like, why you gotta put X? Like, when we be acting, we for real. Okay, Android X. I don't even like the word X. Like, Android X. Whoever wrote that. Android X as a massive strategic move for Alphabet. You know, they move by Alphabet, which is Google. Okay, decide defensively to protect and expand the Google search and advertising empire rather than to directly maximize profit. Who wrote this? I mean, we need a redo. I don't like this. Look at this. They trying to play us with the percent. You see it? How many percent? 72%, 72.77%. All them sevens, y'all. Global mobile operating system market share as of late 2025 and over 3.9 billion active users. Now, see, Apple didn't give us how many users they got. They did not. Nope. And didn't. Okay, and Android ensures that Google remains the default gateway of the internet, creating a near insurmountable barrier to entry for potential competitors. Here is a detailed breakdown, blah, 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 right? So you can Google this and you can read it, right? But I was just showing y'all the economic moat. So that was number 4, right? I'm just showing y'all, who has what competitive advantage over the other. So that's how you know. You just Google it. What is so-and-so economic moat? So if you didn't learn anything today, you learned what an economic moat is. Pretty much a competitive advantage over your competitor, obviously, right? Yeah. All right. That's number 4. Okay, we're just gonna go down a little list here. Okay, and we're gonna wrap it up, and then we're gonna just have part two next time. Okay. Now, all right. So I'm gonna introduce you guys to what is called a 10K statement. Okay. You never heard of a 10K statement? We're gonna look it up and look in the business part of the 10K statement. Okay, so 10K statement. So let's check it out. Boom. I like to look at Google, because that way you ain't got to take my word for it. 10K statement. I'm putting y'all on some couple of things to look at. A 10K statement. Let's look at that. So, a 10K statement is a comprehensive audited annual report filed by U.S. public companies with the SEC detailing financial performance, business operation, risk, and management analysis. It provides more detailed information than the annual report to shareholders, covering the previous fiscal year's results, legal proceedings, and executive compensation. Okay, so some of the things it includes like business, you got risk factors of the company, management discussion and analysis, which is like abbreviated MD&A. You have the financial statements, what we briefly looked at, because that's also included in the 10K statement. And then we have the purpose. So what is the purpose of the 10K statement? Transparency. You have investment analysis, and then you have filing deadlines. So basically, long story short, this is to keep the company finances and everything intact, and so that they can be totally transparent with their consumers and customers, right? So it's mandatory in-depth document distinct from the 10Q. So 10Q, Q means quarterly, gives you the quarterly report, and it can be found via right here, SEC's Edgar database, right there. So see how cool Google is? And I just learned all of this stuff out as I became an investor a few years back. So all of this stuff was new to me, and I'm like, oh my God, so much. But honey, what's it gonna do? But yeah, is make you smarter. I mean, the smarter you are, the more profitable you become. I mean, like, hello. So that's that, right? Then next one, number 5. Do the company, I guess since y'all want to focus on Apple, but focus on Apple, have a high ROC. ROIC, sorry, return on invested capital. Does Apple have a high ROC? As a matter of fact, since we comparing things, you can just ask Google, honey. Check it out. What is Apple's ROIC? Bam. Okay, and I tell you right there. Apple maintains an exceptionally high return on invested capital. Return on invested capital. Generally ranging from 40 and 70%, right? That's pretty dope in recent years between 2021 and 2025, reflecting immense efficiency in capital allocation as of 2026, trailing 12 months, the TTM. So when you look up like on the bar charts or Yahoo Finance, Google Finance, you're going to see this TTM a lot. At first, I was like, what is that? Like, I don't even know TTM, man. But then I had to Google it. I'm like, oh, trailing 12 months. That's cute. So then you got ROIC, which is reported around 38.51%, significantly exceedingly and abundantly, its weighted average cost of capital, the WACC. That's what we call WACC. That's what I call WACC, because WACC spells what? WACC. Okay, cool. Not like whack, corny whack, but you know what I'm saying. But weighted average cost of capital. Wow. So you have to distinct the difference between the WACC and the ROIC, return on invested capital. And then you have the weighted average cost of capital. Okay, two different things. Okay, two different things. But you do want to know both of those because they are important to you as a shareholder, you as an investor, and if you want to day trade, you as a day trader. You know what I'm saying? So here's a couple of highlights for you right there. So That's number five. So you write it down. So we're gonna go on our list. We're gonna keep on. We're gonna stay on path. Okay. Now is next. That's number five, I think, right? High ROIC. Now clearly Apple does, okay, ranging between 40 and 70%. That is dope. Anything over 25 is great. That's what you want to know. Write that down. Anything over 25% as far as a ROIC is Tony the Tiger. Great. Okay. Now, how do you know if they have a high ROIC? I just told you over 25%. Okay. Write that down. Okay. Do they have a lot of debt? Now that's important. That's when you go back to the liabilities. This is the debt. Right here. Ooh, child. Look at that. That's two commas now. 287, 912. Look at that. 302,083, 294,37, 308,030, 285, 508. Now, this is important. All companies are going to have debt. There is no perfect company out there. Not one. Zero. Zipper, 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 zipper. You have to figure out as an investor, where do I want to bend? That's important. Because if those liabilities aren't like decreasing over time, okay, so case in point, right? 287, 912. That was in 2021. Boom. Then you get to 302. You're like, wait a minute. That thing done grew a little bit. Like, whoa, okay, that's a lot. Okay, then it came down. They did a little something, something. Now, you gotta remember, this is COVID, so everybody was, like, having a good time. Wasn't nobody paying any phone bill, whatever the case was. 290, right? And then boom, between 2023 September to 2024, a year later, that thing jumped like 290 to 308. Oh my gosh, that is just so high. Like, whoa. I mean, but we talk about $1 billion company too. So boom. And look, the values are in thousands. So boom. So it did drop though. So from 2024 to 2025, which was just in September, right? They did do a good job to drop their debt because you have to it's a lot a company has to do to get their debt to decrease. It's so many aspects. That's why a lot of companies have accountants because, like, one person to do it's just a lot. But Apple is Apple. They got buku dollars. They can do that, right? So apparently they put some things in place and then they took down their debt. And remember, I said you want the assets to be more, which it is, than the liabilities. That is just a definite rule. Any company that you want to invest on, make sure that the assets are more than liabilities. If it's not, run, run, run. That means the management is horrible. Okay. All right. So that is that. ROIC. And that is that. That is that. That is that. Are they generating profits from their investments? That's what that means. Return on invested capital. Are they generating profits from their investment? So if Apple invests into an event or into a company or into a Tesla or whoever, honey, are they getting a return back? Are they making smart financial decisions? That's what you want to know about the company, because if they invest their money and making good decisions, then you can trust them with your money because that means they'll help your money grow. You see how this works? They're like one and two and one and two and one and two and one and two. All right, so that's that, right? Next one, number 6. Do they have good management? How do you know if a company has good management? I think I said it a couple times. If you were paying attention, if you wasn't, go to the principal's office. So, a company has great management if you look on the income statement, the balance sheet, and the cash flow, and you see more green than red. If you see more green than red, the company has amazing management. If you see more red than green, guess what that means? I'm gonna let you figure it out. I'm gonna let you figure it out. Because I know you can do it. I know you can do it. You can do it. You can do it. I have faith in you. I have faith in you. I have faith in all right. Okay, so do they have good management? I said that, right? Do they have a lot of debt? I said that, right? Assets should be more than liabilities. I said that, right? Should be two assets to one liability. Two assets to one liability. You do the math on that. Okay? Then you look at total assets, right? Total. This is here. Look at the total. 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 Not like total, the group, but total assets right here. Boom. You look at that. Why do you look at that? Why is that even important? Anybody know? Because assets tell you a lot. That's why you should look at it. Now, if you ever see a company, you come here and those liabilities, this number bigger than that number, like I said, run. Because that is just really not the business. You that's not what your eyes want to say. You don't want to see that. You don't. You don't. And if you do, I'm just telling you, run. Trust me. MuMu got you. MuMu got you. Okay. I ain't gonna let you go up like that. Okay. Okay. All right. Now, you also want to look at the total equity gross minority, right? So 2 to 1 means 3 million in assets and 1 million in debt. I'm gonna say that again for the people in the back who wasn't paying attention. Like, what did she say? But remember, you can always rewind this, and that's why we're recording and we're live. Okay, so the whole shebang. 2 assets to 1 liability. You got that part, right? 2 assets to 1 liability. Okay, 2 to 1. Then you look at the total assets. Then you look at total liabilities. Okay, all right here for you on the balance sheet. Where do we find that, Moo? Balance sheet. Right there is right on bar chart. We are on barchart.com. You type in the ticker and just scroll down. You look on the left over here under finances. Okay, boom. We get that total assets, total liabilities, and under that is total equity gross minority, right? Boom, 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 boo-doo-doo, boo-doo-doo, boo-doo-doo. Okay, and then after that, 2 to 1 means 3 million in assets and 1 million in debt. That's what total assets and liabilities mean. So hopefully you got that. All right, so I'm about to wrap this up and oh yeah. So if it's a startup company, right? Because we got a lot of penny stocks and we have like stocks that's not quite on the brokerage, meaning that they have an IPO, right? And let's look at what is IPO. Oh my gosh, I got you. Google IPO. Got you. IPO means in business. IPO, initial public offering. It's the process where a private company sells shares to the public for the first time. It's like they graduated, like, yeah, got my capping gown, and it's time to turn up. Woo, woo, like they did it. We made it. We made it. Hey, yeah, that part. So, private company sells its shares for the first time, transitioning into a publicly traded entity listed on a stock exchange. Oh my God, they made it. I made it. Made it. Right. So, they got to do some work though before they even get there because, you gotta graduate. You gotta like prove yourself like you even worthy to be on somebody's brokerage. It is used to raise capital for expansion, pay down debt, or provide liquidity to early investors. So purpose. Companies go public to raise funds for growth. So everybody get a good start. It's like that first day of school, like boom. You get your new outfit, get your new kickies, you know what I'm saying? You popping and all that. And then you like, fresh start. I ain't failed no classes. Yes, Lord. Boom. That's how the company started out there. They just coming through like, all right, this is our chance to prove ourselves. They're going to increase brand awareness. They're going to provide an exit for early investors, maybe. So they can go public and raise money, right? Because that's what the whole stock market is about, raising money, building your portfolio. So your money helps other companies raise money and they make more money off of your money. And in the process, you make money. Does that make sense? If you didn't catch it, catch up. Process. The company typically hires investment banks to underwrite the offering, arrange regulatory compliance, for example, with the SEC, and set the initial share price. Then you got the benefits to access capital markets, increase visibility and prestige. Prestige. That's stuff that the company had beforehand. So if they just, they low on their marketing or, they wasn't making that much money. So it's like newer companies who hasn't had the correct branding awareness. And then you got to figure out what sector that you're in. And we're going to talk about that more so on the next video, the different sectors, the different industries, the competitions and things of that nature, and all of that. Okay, so wrapping up, if it's a startup company, you got to do a little more digging. You want to be like, okay, you want to look up who's the CEO of the company, right? Number one, who's the CEO? And you got to find somewhere in the media the CEO, like, are they even talked about on CNBC? You got to listen for that, right? You got to see like what's their presence online. Like if you put the company in Google, how many pages come up? One, none. You know what I'm saying? You got to like research. But the new companies, you know what I'm saying? Like, don't sleep on them just because they new. Like they crawling. Don't be like that. Like everybody got to start somewhere, right? Everybody got to start somewhere. So, but the CEO should be able to tell you when the company is going to become profitable. Okay. Amazon then become profitable for over 20 years. Jeff Bezos, yeah, Google it. Google it, baby, Google it, baby. Not making it up. 20 years. So a lot of companies don't get off the ground. You know what I'm saying? It take a while, because you new, you're trying to figure stuff out. You probably ain't got no sponsors. You don't have a building. You're just trying to get it how you live. You know what I mean? You know how it go. Like, being an entrepreneur is not easy. Okay? If it was, everybody be an entrepreneur. Sometimes you gotta reinvent yourself like two, three, four, five times, or if not, 20 years. Now, that's a long time to just be like, you know what, I believe in this, because Amazon was just like a corny company back in the day. But over time, like over COVID, like to me, COVID put Amazon on the map because when nobody going to the store, okay? The gas stations wasn't even pretty much open, barely, right? It was like gas stations and Walmart and hospitals, like the only thing open. Then people were like, oh, DoorDash. No, they ain't working either because they at home too. But anyway, Amazon, that is the only company that I know of that like blew up during COVID. I mean, I'm pretty sure it was other one, but that one's just like they was like everybody was ordering Amazon. All the bikes was gone. All of the the paper towels and the tissues was gone. The Clorox wipes was gone. You know what I'm saying? People were just ordering stuff just to be ordering it, right? It's like, okay. But them workers still was working, honey. They needed them checks, honey. They ain't fired them Amazon workers, honey. They still working. Yes, sir. But all right. Boom. Next one. I think we on 7 or 8. Okay, and yeah, wrapping up. So, are they an industry leader? We're going to talk more about that on the next go round. Okay, and what position do they fall in within their industry? Where does Apple fall in with the tech industry? You got Microsoft, got Google. Where does where do they fall? If it's 8 of them, are they number 4, number 5, number 1, number 2? Where do they fall? That's something that you want to like look at, right? And then you got to look at percentages and profit margins here. Okay. That's what you want to look at, percentages and profit margins, because that's also going to help you make good financial decisions as well. And then what is the net profit percentage? All these can be found on bar chart or Yahoo Finance, Google Finance. I done put y'all on game with the websites. Don't you worry, I got you. Okay. And not the dollar amount. Not the dollar amount, looking at percents. Okay? Percents. Percents. That's what we want to look at. Per cents. Because it makes sense to look at the percents and not the dollar amount. Okay? That's what you do. All right. Are now that's number 8. This is number 9. And then we got one more, number 10. All right. Are they paying down the debt? You want to look at the debt. That's what we did on bar chart. Bar chart. Remember. We looked at the debt, which is here, the liabilities. Boom. Are they paying it down? It went up 2022. We did this already, right? It went down and it went up and it went down. So, yeah, a little wobbly, little wobble roll, but hey, paying that debt is tough, you know? Folks got credit card debt that been sitting there for eons. You know. Don't judge them. Go to the balance sheets, look at the liabilities. Balance sheets, liabilities is the debt. Liability means debt. Write that down. If you didn't know, right? If you didn't know, look at the debt. Make sure it's shrinking. You want to make sure that the debt is shrinking. Okay? You want to make sure it's shrinking. If it ain't shrinking, keep it moving. But with $1 billion company, you already know it could be flip flop. Like I said, it's no perfect company out there. It's just not. Nobody's perfect, and it doesn't exist. So if that was in your head, get it out. Okay. All right. Also, you want to view the revenue. Okay. Bottom line. Is the company growing? The revenue. The revenue going to tell you, okay? The revenue is going to tell you if the company is growing or not. That's how you know. Like, remember I told you about the management? If you see more green than red, right? How do you know if a company is growing? Well, you look at the numbers. Hello. Look at all of them. Look at all of them. The sales. Look at their sales. And look at this. iPhones. Look, 65, 365, 394, 383. It dropped. 391 went back up. Look at that. 416. Now that's retarded. That's the highest it's ever been. And sales. And they sales growth. That was just 6% up from there. But that's a big number. That's heavy. You know what I'm saying? That's heavy, heavy, heavy. All right. That's heavy. That's good. You know what I'm saying? So if you see the sales growth growing, that's what you want to see. That's what your eyeballs want to see. All right. Okay. Now, last but not least, has the company ever halted or frozen the dividends? Okay. That is important because if you Google, matter of fact, let's do it. And then that's it, we done. I don't even want to be on here 30 minutes. I don't know how I got over here for an hour. I don't know. Okay. Has Apple ever halted or frozen dividends? Oh, thinking. Yes. Ho ho. Ho ho. No, I'm just kidding. Android probably did too with Google. Y'all know they owned by the Google people. Alphabet. I bet y'all ain't know it was Alphabet. Maybe you did. I don't know. Alphabet Inc. Yes, Apple Inc. has both suspended and frozen its dividends in the past. Let's look at the keyword here, people. I'm being a hater. Famously, I'm just saying. Apple famously halted its dividends entirely for 17 years from 1995. Lord have mercy. Look, I'm just learning this my damn self right here. Woo! Look, I gotta take a drink on that. Look. 17 years? Whoa, that's a whole teenager. Like, that's a whole high school period. Like, first grade, 12th grade. Like, I was 17 when I graduated. So from 1995 to 2012, right? So previously the dividend remained flat. Flat like a pancake. Okay? Flat like a booty. All right. Frozen between 1995, I'm sorry, 1990 and 95, and it was originally paid from 1987 to 95, right? But since 2012, the dividend has been increased annually. So they had a little rough patch. That's what this means. In blue right there. You see that blue? It means they had a rough patch. Okay. 17 years, rough patch. I didn't even know that, honestly, until I just looked it up. All BS aside. Aw. But guess what? If you are Apple shareholder now, I bet you're getting that bag, because they got it back together. They are doing what? Increase annually. Whoa. All right. Suspension. Hello. Why were they suspended? Aw, look. They were struggling with weak demand. Nobody was buying Apple. Apple stopped paying dividends in 95 to preserve cash. Basically, they ain't have it. They ain't have it. Just go on, keep it funky. Call us spade a spade. They ain't have it. And we talking about in 95 now, you know what I'm saying? We talking about whoop when there was no cell phones like that. It was more like pages going into the cell phone era, right? Around that time. They were struggling. Apple stopped paying to preserve cash, right? A policy that continued through the return of Steve Jobs, rest his soul, in the company's turnaround phase. Huh. So then, fast forward, you see how they just jumped. They like, all right, boom, 17 years, and then boom, they brought it back. You know what I'm saying? Boom, 2012, present growth. Following 2012 reinstatement, Apple has not frozen. Okay, they say get that together. What you thought? What you thought? What you thought? What? Apple has not frozen or reduced its dividends not one time since 2027. Okay, I think I might have Apple. All right. Instead, it has followed a pattern of annual increases, raising it from 38 cents. 38 cents now. Okay. 38 cents per share in 2012. They have augmented their dividends to $1.04 annualized in 2026. Let's come on. All right, I had to shop music. Apple, we made it, hey, we made it. Current strategy. Let's read their strategy and then we out. Apple currently prioritizes consistent. Let's look at the words here, people. The verbiage that they're using: moderate dividend growth alongside massive share repurchases rather than high yield, aggressive dividend hikes. Aggressive dividend hikes. They trying to hike. Put your boots on, put your Timbs on, and let's hike and get aggressive. Let's hike and get aggressive. All right, I'm done. Well, that is it, five people. I'm just gonna go do a little quick recap for your list. I hope y'all was taking notes. You know what I'm saying? I had to go over some things and add my little personality there to it. All right, boom, stock picking. Next time we're gonna go over the sectors, the industries, and all that type of stuff. So you gotta stay tuned in, okay? Simplicity was number one. Then we had, does the company have free cash flow? And is the net profit going? That was number three. Look at the balance sheet for that, and then look at the cash flow statement. All right. Next, do they have a moat? Right? And then I introduce you to the 10K statement, and then look for the business in the business section of the 10K statement. And then you got the 10Q, which is quarterly, and so forth. All right. Next, number five. I think number five. Do they have a high ROC? ROC, remember, is a high. I'm sorry, not yeah. Do they have a high ROIC? ROIC. Let me get it together, self. All right. Return on invested capital. Okay. It means that they can take money, put it into the market, make it back from doing that. Make it back from doing that. You like it, that rhyme? I'm a poet. I didn't know it. All right. Generating profits from their investments. Basically, that's what that means. All right. Cool. If you didn't get it, rewind it back. Take that. Rewind it back. Look, that make the go. All right. Do they have good management? How do we know that? That's your homework assignment. I done repeated that about 3-4 times. How do you know that? Well, do they have a lot of debt? That's the liabilities. Remember, assets should be more than the liabilities. I said that should be 2 assets to 1 liability, right? If it's a startup company, the CEO need to let you know when they were profitable, and that's when I use Amazon as an example because they weren't profitable for 20 years, and then they got to that COVID because Amazon just was like wasn't selling everything at one point, so you gotta believe in your dream. Like Jeff Bezos said, the man believe, okay? Stay down, like Mary say, stay down. All right, now, next. Are they an industry leader, right? Is Apple an industry leader? If they're in the billions, yeah, I'm just using Apple as an example, right? In what position do they fall within their industry? You need to know that as well. And you look at the percentages, you look at the profit margins, okay? Then what is the net profit percent? That's what you want to look at, okay? And not the dollar amount. Remember I said that. Now, next one, are they paying down the debt? Is the debt growing or is the debt decreasing? You want to look from right and then come left. Okay. All right. That's that. Now you go to the balance sheets to see the liabilities. Remember, look at the debt and make sure it's shrinking and not growing. And with that, also, you look at the revenue at the bottom and make sure that that matches. That's what you want to do. Okay. Last but not least, what did we look up here? Has Apple ever halted or frozen its dividends? Make sure that the company has not. I mean, if they had to do what they had to do, they had to do what they had to do. I mean, baby girl, baby boy, things happen, right? But yeah, that's not a good look. 17 years. Now, sometimes folks, freeze them about a year or two, but 17, but you got to look at when they frozen though. I guess I give them a pass. Because they real big on their iPhones, and I think that's the bulk of their money, the iPhones and the laptops, right? And then they got the Apple Watches, like I can't keep up. Then they're gonna come up with the Apple glasses like Meta, like I can't keep up. Then they're gonna come out with a car. I don't know. But they got a lot, right? But anyway, yeah, they had to take a 17-year break. Judge ye not, ye not be judged, right? But I guess outside of Apple, they don't get a pass. They probably do get a pass because you got to look at what they're selling, right? The consumer, the supply, the demand, and the time of that it was. Nobody was buying no Apple phones back then because there wasn't no freaking phones out back then. It was just Apple computers, and you put the little disk in there and floppy disk, who knows? But anyway, you know what I'm saying? And just invest like 25% of your money. But we're going to get more in deep into how the market works. We're going to get into the sectors. We're going to get into the industries. And we're going to get into some things. So I'm going to keep giving you guys some free, cool information on fundamentals. Remember what fundamentals are? Research, knowledge, experience, those type of things. What are the technicals? Price action, market structures, moving averages, strategies. Yeah, that's the difference. I don't want you to get confused, but that's what I teach in the Wealthy Westcott University class is the technicals. Now, the fundamentals I want to share with you also you can become a little bit more familiar with investing, how to invest, where to start if you're just starting out or you don't know where to start. We watch the video. We watch the video. So stay tuned in. I'm gonna tell y'all when I'm going live next. And I appreciate y'all for hanging out with me, man. I do. It's your girl MuMu. And also, too, you can feel free to join my Discord. We live trade. We live traded today. Live trade on Tuesdays. We live trade on Thursdays. When you're trying to get a feel for it, the Discord is free. The VIP is $60 a month or $25 a week. So, or you can try it out one time for $35. So, that's totally fine. But go on my Instagram, ATL time, the number 2 shine. The Discord link is in there. You can also go on a YouTube page at Wealthy Westcott. And it's in the description of each video. You can check it out there. And if you want to learn how to read stock market, wealthywestcottedu.net. Wealthywestcottedu.net. All right. So hopefully everybody had a good Valentine's weekend. Good Super Bowl. You know what I'm saying? So I'm gonna be going live a couple times a week to give you guys some cool information, especially, it's like one lesson is gonna piggyback off the other type vibe. So yeah. So that's that. And let me stop sharing because sharing is caring. All right. So thank you guys for hanging out with me today. You can watch the video back. I'm your girl Mo Legend. Everybody calls me